Two friends, same age, same city, same job, same salary, $55,000 a year. And on the same exact day, both of them have $50,000 sitting in their savings account. One of them buys a rental property. The other buys index funds. Both of them walk away from that decision convinced they just made the smartest financial move of their life. 20 years later, we're going to open both of their bank accounts. And what you're about to see is going to make your stomach drop, because one of them is about to discover they spent 2 decades working a second job they never got paid for. And the other is going to discover that doing absolutely nothing was the hardest part. This is the real math behind real estate versus stocks, not the YouTube thumbnail version, the version that includes everything.
Let's call them Ethan and Noah. Ethan and Noah, same starting line, $50,000 each. $55,000 salaries, same city, same age. Ethan takes his $50,000 and uses it as a 20% down payment on a $250,000 rental property, a modest 3-bedroom house in a decent neighborhood. He takes out a 30-year mortgage at 7% interest. His monthly payment comes out to around $1,330. Within a few weeks, he finds a tenant willing to pay $1,800 a month in rent. Ethan does the math in his head. $1,800 coming in, $1,330 going out. That's $470 a month in pure profit before he spent a single extra dollar on anything. Ethan feels like he just unlocked a cheat code. Noah takes the exact same $50,000 and puts it into a total stock market index fund. No tenants, no keys, no property to drive past on his way to work. He sets up an automatic transfer, $300 a month, and basically never thinks about it again. When his coworkers ask what he's investing in, he says index funds. They nod politely and change the subject. Nobody's impressed.
On day one, Ethan has a house, a tenant, and a story to tell at every dinner party for the next year. Noah has a brokerage account and a confirmation email. It is not even close in terms of how it feels. But feelings and math are about to become two very, very different things. For the first couple of years, Ethan is living the dream. Rent checks land in his account like clockwork, the first of every month. He drives past the property on his way to work and thinks, I own that. Tax season comes around and he's writing off mortgage interest and depreciation, shaving a couple $1,000s off his tax bill every year. Every mortgage payment is building him equity. And every few months, he checks the listings. Comparable homes in the neighborhood are quietly ticking upward in value. Everything about this feels real, tangible, smart. Meanwhile, Noah logs into his brokerage account once a quarter, if that. The number goes up a little, then down a little, then up a little more. Year one, his $50,000 grows to about $55,000. Year two, maybe $61,000. It doesn't feel like anything is happening. There's no key in his pocket, no tenant texting him about a leaky faucet at 11 p.m., no asset he can point to from his car window. Just a number on a screen. Ethan's friends ask him about the rental property constantly. Noah's friends don't ask him anything. And honestly, the social proof alone makes Ethan feel like he's winning by a landslide.
Let's actually look at the numbers by year 3. Ethan has collected roughly $64,800 in rent over those 3 years. His mortgage payments over the same period total about $47,880. That leaves him with $16,920 in gross cash flow. Sounds incredible until you start subtracting everything else. Property taxes, about $3,000 a year. Insurance, another $1,500. He's already replaced a water heater for $1,200, fixed a leaking roof for $2,800, and dealt with 1 full month of vacancy between tenants, $1,800 in lost rent, plus $600 to clean and relist the place. He's also been managing it himself to save money, which means phone calls at 10 p.m., weekend showings, and coordinating repairs on his lunch break. After every real cost is subtracted, Ethan's actual net cash flow over 3 years is somewhere between $2,000 and $4,000, not the $16,900 that looked so good on paper. And that doesn't include a single hour of his own time. Meanwhile, Noah has put in his original $50,000 plus $10,800 in monthly contributions, growing at roughly 10% average annual return. His portfolio is now sitting around $76,000. He spent 0 hours managing it, 0 phone calls, 0 emergencies.
But hold on, Ethan still has one major advantage working in his favor: leverage. His $250,000 property has appreciated maybe 3 to 4% a year, and it's now worth somewhere between $270,000 and $280,000. His equity, the gap between what the house is worth and what he still owes, has grown to roughly $55,000 to $65,000. That's real wealth. And part of it came from using the bank's money to buy an asset that's now worth more. That's the power of leverage, and it's the one advantage stock investors genuinely can't replicate easily. Here's the thing, though. The rent check is the number everyone talks about. It's the number on the YouTube thumbnail, the number at the real estate meetup, the number your landlord friend brags about at the barbecue. What almost nobody talks about is everything that quietly comes out of that rent check before any of it is actually yours. Vacancy. The average rental sits empty about 1 month a year. That's not a disaster on its own, but it's a full mortgage payment with zero income covering it. Maintenance. The general rule of thumb is 1 to 2% of the property's value every single year. On a $250,000 house, that's $2,500 to $5,000 annually. Some years it's a $200 faucet repair. Other years it's a $7,000 HVAC replacement. In August, while your tenant is threatening to move out.
Capital expenditures. Roofs last 20 to 25 years. Furnaces, 15 to 20. Water heaters, 10 to 12. These are guaranteed future costs, and they arrive in chunks of $5,000 to $15,000. If you're not setting money aside every month for these, you're not running a business. You're running on luck. Property management. Hire someone, and that's 8 to 10% of monthly rent, gone immediately. Manage it yourself, and you're working a part-time job you're not getting paid for. Either way, it costs something. And then there's the risk almost nobody wants to talk about out loud: a bad tenant. Someone who stops paying and knows exactly how slow the eviction process is can cost you 3 to 6 months of lost rent, plus legal fees. One bad tenant can wipe out an entire year of profit, sometimes more. None of this shows up in that $470 a month number. But it shows up. Eventually. It always does.
By year 5, Ethan is deep in the actual reality of being a landlord. He's on his 3rd tenant. He's replaced the roof, $8,500, dealt with a plumbing emergency, $1,400, and spent another full month with the property sitting empty between tenants. He's raised the rent to $1,950, which helps, but his property taxes and insurance have gone up too. His actual cash-on-cash return, the money he's pocketing relative to what he originally put in, is hovering around 3 to 5% after all real expenses. Not bad, but nowhere close to the 15 to 20% he was telling people about at the barbecue 5 years ago. Noah, meanwhile, is still doing absolutely nothing. His portfolio has grown from $50,000 to somewhere between $135,000 and $150,000 by year 7, including those steady $300 monthly contributions. He didn't pick stocks, he didn't time the market, he didn't do anything except not touch it.
And now, the compound growth is starting to accelerate. The gains on his gains are generating more new wealth each year than his original contributions ever did. Here's what's actually happening underneath the surface. Ethan's wealth is growing, but slowly, after expenses, and it requires constant attention. Noah's wealth is growing in a curve. Slow at first, then faster, and faster. Compounding is boring for the first 5 years, and astonishing for the next 15. By year 10, Ethan's property is worth somewhere between $335,000 and $350,000. His remaining mortgage balance is around $166,000. That puts his equity at roughly $170,000 to $184,000. Over those 10 years, after subtracting every real cost, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, Ethan's total out-of-pocket spending beyond his original down payment is somewhere between $20,000 and $35,000. Noah's portfolio, with his consistent $300 monthly contributions and roughly 10% average annual returns, is sitting at approximately $165,000 to $180,000. He put in $50,000 up front plus $36,000 in contributions, $86,000 total. The rest, pure compound growth, and he spent exactly 0 weekends fixing anything. At year 10, they're surprisingly close. Ethan might even be slightly ahead thanks to leverage. But here's the part that doesn't show up on a spreadsheet. Ethan spent hundreds of hours managing that property. He took on hundreds of thousands of dollars in debt, and his entire investment is concentrated. One asset, one zip code, one roof that could fail at any time. Noah is diversified across thousands of companies and hasn't lost a single night of sleep over any of it.
This is where everything fully separates. By year 20, Ethan's property is worth somewhere between $450,000 and $500,000. His mortgage is either paid off or close to it. His equity sits somewhere between $400,000 and $500,000, depending on how the market behaved. He's been collecting rent this entire time, but after 20 years of maintenance, repairs, tenant turnover, taxes, insurance, and at least one major renovation, his total net profit from cash flow might land somewhere between $40,000 and $80,000 above what he spent. Maybe more in a hot market, maybe less in a flat one. Noah's portfolio, at that same 10% average annual return with his $300 monthly contributions, has grown from $50,000 to somewhere between $420,000 and $460,000. Total contributions over 20 years, $122,000. The other $300,000 plus, pure compounding. No debt, no tenants, no 2 a.m. phone calls about a broken pipe. When you compare net worth side by side, they're in the same ballpark, somewhere between $400,000 and $500,000 each. But how they got there could not be more different. Ethan worked for his. Noah waited for his. Ethan had stress, concentrated risk, and an asset he couldn't easily sell if he needed cash fast. Noah had volatility, but liquidity and freedom. And here's the detail that changes the math dramatically. If Noah had simply increased his monthly contribution by $200, bumping it from $300 to $500 a month, his 20-year portfolio jumps to somewhere between $550,000 and $600,000.
Why? Because in the stock market, increasing your contribution has a multiplied effect through compounding. In real estate, increasing your investment usually means buying another property, taking on another mortgage, and doubling your workload. Now, if I only showed you the downsides of real estate, I'd be doing exactly what every stock market influencer does. So let's be fair to both sides. Stocks have real risks people love to gloss over. Volatility is brutal. In 2008, the market dropped roughly 37%. In March 2020, it dropped 34% in a single month. If Noah had a $150,000 portfolio and watched it fall to $95,000 in a matter of weeks, that's not just a number on a screen. That's gut-wrenching. And the data is clear. Most retail investors panic sell during crashes and buy back in after the recovery, locking in losses at the worst possible time. There's no cash flow. Unlike a rental property, index funds don't send you a monthly check. Dividends exist, but on a total market fund, you're looking at maybe 1.5 to 2% yield. On a $150,000 portfolio, that's about $200 a month. That's not replacing anyone's income. No leverage. Noah used $50,000 to control $50,000 in assets. Ethan used $50,000 to control $250,000 in assets. That 5-to-1 leverage is enormously powerful when property values rise, and it's the main reason real estate creates more millionaires than the stock market in many surveys, in most surveys. And no tax magic. Real estate investors can deduct the theoretical decline in their building's value from their taxable income, even while the property is actually appreciating. That's a legal tax shelter stock investors simply don't have access to. Real estate isn't a bad investment. It's a misunderstood one. Real estate genuinely wins in specific, identifiable situations. If you're in a market where the rent-to-price ratio is strong, meaning monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works in your favor from day one. If you treat it like an actual business, not a side hustle, screening tenants carefully, budgeting for capital expenditures, building real systems, the returns can exceed stocks, especially with leverage working in your favor. If you use strategies like house hacking, living in one unit and renting out the others, you can reduce your own housing costs to near zero while still building equity. That's something the stock market simply cannot replicate. And if you understand something like a 1031 exchange, which lets you defer capital gains taxes by rolling profits into a new property, you can grow a real estate portfolio in ways that stock investors can't match without retirement accounts.
Ethan and Noah both walked away from their decision 20 years ago convinced they'd made the smart play. Ethan believed real estate was the proven path to wealth. Noah believed the stock market would just do the work for him. Neither of them sat down and mapped out what this would actually cost, in dollars, in time, in stress, and in risk. Over 10 or 20 years, the real trap isn't real estate, and it isn't stocks either. The real trap is picking one of them based on a YouTube headline, a podcast clip, or something your uncle said at Thanksgiving, without ever running the full numbers for your actual situation. And if you're wondering what happens when someone does both, owns property and invests in the market at the same time, that's a completely different conversation. One where the math might change everything you think you know.
But for now, the next time someone tells you real estate always wins or the stock market always wins, ask them one question. Did you include everything? Because the answer that includes everything is the only answer that actually matters. If understanding how money actually moves and where it quietly disappears is something you're into, go watch our breakdown on the salary trap, why the system keeps you broke. It explains the part of this story that happens before you even have $50,000 to invest in the first place, and it might change how you look at your own paycheck completely. Subscribe to Matt Finance. New breakdowns like this every week. See you in the next one.